The next thing I want to move on to is decision frameworks. I'm going to share with you my high level framework for how I evaluate every single company. Those of you who have paid attention to my deal flow, have seen the investment memos that we write, you will know that we adhere to this format, right? If you read through it, it's these 8 things that we focus on. I would say that when it comes to decision making and due diligence, you want to think about going very broad and to get a broad scan of a company and to find areas where they need extra attention, right? Rather than starting narrow and going very deep, because it leaves a lot of blind spots for you. So that's my approach. And this framework is designed to do just that. Our decision framework covers these 7 things. We are looking at the product or service. We are looking at the market. We want to understand the economics of the business. We want to know what potential sources of defensibility there are at scale. We want to look at traction because traction is hard metrics and numbers that you can count on. We want to evaluate the team and we look at valuation. Very simply, when we talk about product and service, all we're looking to understand is what does this business do? Okay, how do you sell? What is your product or service? How do you make money? Second, for the market, we're looking to understand, do you understand who your buyer segment is? Who is your ICP? Are they willing to pay? And when you consider these facts, how big is this potential market? When we look at economics, we're trying to understand what is the value of each sale and how profitable is it for each unit of sale. So all things equal, if you sell something that's $10,000 versus $100,000 per unit, that's better. And a product or service that has 80% gross margins is better than 60% gross margin, right? All things equal. For defensibility, I think the best way to frame this question is to think, okay, when the business is established, what about this is hard to build? This is what's going to keep competitors out. And then traction, you need to be able to define the right metrics for the particular business and the business model. If you are evaluating a consumer business, you might be looking at things like lifetime value and customer acquisition costs. Growth rates are important. There's this saying in venture that you want to invest in a line, not in dots, which is whatever company you invest in, you want to see a clear trajectory of growth. If you are investing in a marketplace, you want to understand the GMV, gross merchandise volume, and the take rate. What percentage of that, the transaction volume, that the business is keeping. And this is one area to be very careful about because sometimes founders will get creative and they will represent GMV, the overall process volume, or revenue, which is simply not true. So take an example, a fintech that does payment processing. You could be processing $10 million a year, but your take rate, because it's payment processing, might only be 0.1%. And therefore, your revenue is only worth $10,000 or something trivial like that. I pay a lot of attention to revenue, both the ARR, annual recurring revenue, and the net revenue retention. We are sensitive to profitability. I like businesses with big, fat, thick margins. And then also we pay attention to capital efficiency. Very simply, how much is this company burning to grow? And on the team is one of the most subjective things to evaluate in this whole framework. Generally speaking, I look for 2 things. One is founder market fit. Do the founders know the space that they are building for? Because otherwise, it's pretty hard for you to build a service that's attractive to consumers if you don't know the market in the first place. The other question that I'm looking to answer is how serious and committed are the founders? It's very direct. It's maybe not a very nice thing to say. People don't want to hear it. But building a company from the ground up is hard. And building a venture scale company is a lot, right? It takes a certain kind, and people who are not equipped for it, it's not a value judgment on them individually, but as an investor, you've got to make that determination for yourself. And finally, look at valuation. You're looking to answer, is the company fairly priced, given their metric, given everything that is going on? As a general principle, I do think that angel investors tend to overpay. In fact, for me, the data is very clear that angel investors tend to overpay for companies. And it's not until the companies get to Series A, Series B, Series C, that the valuation multiples, let's say we were taking revenue multiples, start getting a bit more coherent. So if you think, one way to think about this is whatever you're investing in, you're investing high and you're looking at that forward-looking growth to catch up with it. Okay, which is why I always encourage angels, don't be afraid to walk away from a deal. If it seems unreasonable, it probably is. It feels like you don't have leverage to adjust that valuation, but the best thing you can do is to walk away with your check and to say that for another day, another deal, there will always be another startup. Okay, so those are the 7 things. What do I look for? Okay, so here are a few general guidelines. When we look at the product or service, high level, can you make the argument that this product or service is differentiated by an order of magnitude? We're looking for something that's 10x better, not 10%, right? Or maybe it's 3x better. But the point is, we're not going for something incrementally better. We're looking for something that is a step change to the alternatives. Second, I do pay attention to market size. And this is exactly because of the axiom that I talked about earlier. The difference between a big market and a huge market could be 1,000x difference. So there's a big order of magnitude difference in what success looks like. And for the economics, I'm evaluating each company for their revenue quality and the unit profitability. So revenue quality can be things like how sticky is the product or service. So if you are selling, let's say, a CRM to a customer or a website builder, those are very sticky products, right? Once a customer adopts it, it's very hard to switch off because it's a big, heavy lift to migrate to another service. So something like that could mean very low churn. Potentially, as customers build out their websites, you can charge more, or they have bigger CRMs, you can charge them more because they're locked in. And then also unit profitability. That's great for me because the more a company is profitable on a unit economics basis, they can take that revenue or they can take that profitability and pump that into growth. So as an investor, it basically means that they need to raise less equity financing, which causes dilution, which diminishes my overall returns. Defensibility, we talked about, right? Basically, the question here is what assets make it hard for others to replicate the business? Traction, understand the metrics for the particular business. This for me is about de-risking and to validate that the strategy that the company is pursuing, whatever the founders are saying, is this actually working? What does the data tell us? I talked about team, looking at founder market fit and serious builders. There is no way to ultimately know this, right? It's going to be very much a finger in the air. Yes, it's a subjective judgment. What you can do when you're evaluating with founders is to actually figure out how much skin in the game have these people put in, because it determines it tells you something about how serious they are. So is this a team that has built something in a garage for a month and went out to the market to try and fundraise without a product? Now, or have they spent their nights and weekends for the last 2 years building out a product to show some revenue and customer fit? Those things show for me skin in the game and commitment from founders. And finally, for valuation, for you as an angel, wherever you invest in today, you're going to be investing most likely on market conventions and benchmark. So you're not going to have negotiating power with the startups. It just tends not to work like that. This is why I build and run my own syndicate, because it gives me a lot more leverage in deciding terms and negotiating valuation. But as an angel, you're not going to have that power. You understand what the pricing is in your local market environment, and you need to decide, is the company worth this? this is your buy-in price, and then you're also looking at your exit. So long term, how big can this company grow? That should be supported by the market side. How well can the founders execute, and which impacts how quickly they grow, right? Those things basically dictate your exit value. So this is my framework. If any of you are interested in seeing an investment memo for a company that I've invested in using this structure, please feel free to reach out. I'm very happy to share this. And in the programs that we teach, we have case studies of actual companies we've invested in, and we talk through in depth this exact framework.